Hey, welcome back to the channel, everyone. My name is Jesse. Today I'm going to be checking out Fiserv. Got kind of a recommendation to look at this along with GPN because I do hold some GPN, and we went over GPN last week, so this fits in well. I haven't really dug into a ton on Fiserv, so this is going to be pretty just like off the bat analysis of kind of what I would do. Let's go over the 10-year chart and 5-year chart to keep the format. We can see that over the last 10 years, Fiserv has had a ton of appreciation, and then we kind of started consolidating sideways here since about 2020. So ton of appreciation on those first like 5 years, and then we've kind of chopped around for a bit. If we zoom into the 5-year chart, we can see that chop here, and we've kind of been in between about 124, 125, and the bottom of the COVID crash was around 75, 76, something like that. So we've been going through a little bit of consolidation sideways. And yeah, with that, let's jump over to the quarterly presentation. All right, so here we have the Q3 quarterly presentation over their financial results. So let's breeze through this and see what we can find. All right, so here we have some of their third quarter highlights. Revenue growth about 8%, organic revenue growth 11%, EPS 11% growth for the quarter and 14% year to date. Operating margins increase 170 basis points sequentially, free cash flow growth, and then they kind of go into returning $750 million to shareholders through share repurchase, reaching a total of 50 million shares since first date of merger. And this was a big merger that we'll see in their financials, how that affected through the share count, but also debt. Achieved leverage of 2.9x. I don't really know what they're referencing here, what the baseline was, but maybe this was the leverage that they took on from that first date of merger between the dilution and the debt raise, maybe. I don't know. We'll see about that in the financials when we dig into them. And here they just present other financial metrics, just kind of in a bar chart: revenue growth, operating margins, free cash flow. Then we have the merchant acceptance segment. So this looks like their merchant segment, 19% growth on their Clover revenue. That's probably a segment of their business. Just revenue +9 or +14. Payments and network segments, so similar. We will notice that their margins, just operating margins, are lower on the merchant side than the payments and network segment side, have quite a bit higher adjusted operating margins, but a little bit more revenue on this side. So, but this appears to be kind of maybe more in a growth phase. So growing a section of the business that has higher margins is definitely a good thing. Go to the fintech side, financial technology segment. Margins are a little bit lower than the payments and network segment, but we're kind of seeing pretty big pullback on a quarter-over-quarter basis. Year over year, they still had some growth, and of course they're going to select the one that looks good, so hey, they still had growth there. But the payment and network segment seems to be potentially in a good trend. I'm guessing a lot of business growth is coming from there, and if they grow in those, if they moderate in these other two segments, but they grow substantially in this segment that has higher operating margins, that's going to be a nice tailwind for the business. Then they go on to say, hey, we're not being stupid with our money. They're allocating capital wisely. So nice little slide there. Different financial metrics. A lot of this is just kind of reiterating things that we've already seen. So cool. Let's jump over to the financials. Actually, before we go into the financials, I want to bring up their previous acquisitions because they have been acquiring companies similar to Global Payments. They've been acquiring companies for the last 20 years, 15 years, 10 years. So they've done a lot of acquisitions to kind of plug into their company, kind of increase their product offerings and their margins. The big one that we're going to see is First Data, that was mentioned in the slide deck. And that was acquired for $22 billion back in 2019. And we'll see a drastic shift in the shares diluted, along with probably the debt, I'm guessing. We'll see what that looks like. But we have to definitely keep in mind that a lot of their growth over the last 5 years is probably going to come from this acquisition. All right, so let's go ahead and pull up Fiserv, FISV, let that load. Grab 10 years of data, and let's go over to the income statement right away. So, all right, so we got the income statement. We can see 2019 after that acquisition. Hey, look at all that revenue growth. And we can definitely see a change in their revenue and their bottom line, their top line and bottom line numbers. Operating expenses, everything kind of went up. Shares diluted went up drastically, but this is also kind of a good thing to look at over the last 10 years. They have been just a constant buyer back of their stock. So we'll see if they were doing that at good levels, maybe. I'm not sure if this was ever drastically overvalued or if they just, probably had a decent time buying their stock back at okay valuation. But even after the acquisition, they have been buying back stock. So they're returning capital to shareholders through buybacks in a pretty big way. And I don't know if they have a dividend. Their dividend is zilch. So no dividend, it looks like. So the majority of capital return to shareholders is going to be through buybacks, and they're probably taking a lot of that cash flow and putting it to debt as well. EPS diluted over the last 10 years, we can see pretty decent uptrend. We'll see what happens in the next couple quarters, though, if we get a drastic pullback or not. Let's jump on over to the balance sheet. Got a skewed kind of input right there, and that was probably a ton of debt that they maybe took on for this acquisition that showed kind of short-term investments in cash rose drastically during that time. But I mean, they've got about just over $1 billion in cash right now in short-term investments. If we look at their debt, total liabilities, long-term debt, we do see right around that time with that acquisition right here, a substantial increase in long-term debt. So I'm guessing that might have been the debt that they inherited from the merger. It also could have been some debt that they paid out in cash for the acquisition. Now, goodwill and intangible assets, kind of what we expect when they did that acquisition. They took on a ton of goodwill. Goodwill has remained constant, which means that most likely they have been getting the value that they perceived that they would get from that transaction, that acquisition. So, and intangible assets, we can see kind of drifting down. So let's go over to the free cash flow statement. Operating cash flow, we can see that has done pretty well, pretty healthy. In 2019, we also see from the acquisition, huge bump up in free cash flow. Not anything like steady growth, but pretty constant. So I'm not sure if we're going to see like massive amounts of growth or not. This is one where like you're probably gonna have to dig a lot deeper to really see what type of tailwinds they have in their business that could push them to the next level without acquisitions, because it's just kind of like after they did that first acquisition, they grew revenue a ton, but maybe not a lot is pumped down to the bottom line. Net change in cash, nothing crazy. We can see with their cash flow, they are mostly doing common stock repurchase and debt repayment. No dividends, not really issuing a ton of common stock either, which is good. So mostly you're getting cash back in the form of common stock repurchased. And then they're working on their balance sheet by paying off that debt with the other cash flow. Go on over to ratios and metrics. We can see a shift again in 2019. Actually, no, 2019 is right here. But kind of we saw like a decrease in operating margins and gross margins. But I'm guessing once they got more fully integrated with that First Data acquisition, that's when we kind of started to see this gross profit margin expansion and also the operating and net profit expansion. So per share metrics have looked pretty good, even if they're not growing a ton organically. If they're doing tons of share repurchases, they're going to increase, their per share metrics. So the nice thing about buybacks is it does actually make an effect long term. They are really returning capital to shareholders. Their per share metrics are going to look better long term as they do more and more buybacks. And here we can kind of see the valuation metrics, yield metrics. So yeah, looks like it's kind of gone down a bit here. So which would mean that historically they're trading a little bit more potentially a little bit more at a premium than they have in the past. Dividend payouts, nothing. And then enterprise value and market cap. And we can see that their enterprise value is substantially higher than their market cap, and that's from that debt that they have. So if we go to growth numbers, we can see obviously they had a huge influx of growth in 2019 from that acquisition. All that revenue and net income came to the bottom line. So huge growth, a little bit less growth, a lot less growth. So the real question is, how much are they going to be able to grow without doing acquisitions? Have we totally seen kind of the realized growth from that acquisition? It's going to peter off and it's just going to be like 8% from here on out? Or are there still synergies to gain to where they can grow organically? I think they said organic growth about 11%. I don't know if that was just for that segment that we looked at or if it was for the entire business. But if they can't find a way to grow organically, then they might just be growing from acquisitions. As we saw previously, a ton of dilution in 2019. And they're starting to do some buybacks now. So full EPS, diluted EPS growth, 2019, offset, and then bam. So yeah, so that's what we got with that. Let's jump on over to the evaluation sheet and start messing with some numbers. All right, so onto the evaluation. As we discussed previously with GPN, if they're doing a lot of growth from acquisitions, we have to really take into account the dilution from those acquisitions along with the growth. And then going forward, we have to make assumptions of like, are we going to expect further dilution for the same growth? Or maybe we put in zero dilution or even buybacks because they've already established and they're going to continue to do less acquisitions, but grow at a slower rate because they're doing less acquisitions, but also they're returning value to shareholders in the form of buybacks. For this one, just like with GPN, what I'm going to do is I'm going to basically do the latter scenario where I'm not going to assume that they're going to do any acquisitions. Instead of diluting from acquisitions, they're going to be doing buybacks. We can see lately they've been buying about 3 to 4% of shares back. So in the best case scenario, I kind of want to see them, 4.8% buybacks per year. And that would assume basically no acquisitions, just organic growth from here on out, which we can see was about 11% in certain segments of their business. So on a dilution basis, what I want is about 4.8% buybacks in the best case scenario and about 2.17% buybacks in the worst case scenario. Now, these numbers are going to be off if they do acquisitions, but if they do those acquisitions, it should positively reflect in the growth numbers if they know what they're doing. Right? Hopefully it's a wash if they do acquisitions because the growth and the bottom line incomes will just increase accordingly, if not better from the acquisition than previously. So for the risk-free rate from the very bullish scenario of 1.99, and this is based off the 10-year treasury, very bearish is 4.87. I think we're sitting right around 3.9 right now. So we got up to 4.4 for a little bit, and then we came back down. So I think this is a pretty good range. Bottom line growth, since I'm not assuming any acquisitions, I've got a top very bullish case of 14.24% on the bottom line growth, with 9.34% in the bearish case. Over the last 5 years, it has been about 8.24% bottom line growth average. And we can see that, and this is the other thing, is revenue grew a ton, obviously, in 2019. If we go down to the bottom line growth numbers, we can see that we had a pretty significant growth in about 2020. So is that going to moderate back and we're going to be looking at pretty poor growth numbers, maybe 9%? I don't know. I'm just, from what they've done previously, I can't say that I'd be confident that this is going to grow 20% on the bottom line because it hasn't previously. Over the last 5 years, we have 19% growth on free cash flow. We have about all these numbers kind of be skewed from that massive acquisition, but I don't know. I would have to know a lot more about the company to be able to have confidence that they're going to reach higher bottom line growth numbers. EBIT yield spread, I kept this basically, I didn't make any adjustments for this. So the EBIT yield spread I'm putting at 0.94, 0.44, and 1.81 on the very bearish scenario. If we go down, we can actually see bottom line yields have come down. So in this case, our yield has come down closer to the risk-free rate or the 10-year treasury. So we've actually seen a decent amount of multiple expansion based off of historical numbers, right? So if it used to trade at a yield of 5 to 6, 7%, and now it's trading at a yield of like 2.5, 3%, we've seen a decent amount of multiple expansion off of this, which, like, I don't know, it makes me a little hesitant, because if we see a reversion, then we would just have, the price steadily kind of selling off and coming down as we come into some different yield spread scenarios. So that being said, the yield spread at the end, or not the yield spread, but the total yield at the end from a very bullish standpoint is 3.06. From a very bearish is 6.55. And on a PE basis, that's going to be between a, 15 to 30 PE, somewhere in there. That might be totally wrong though. I'm doing that off the top of my head. So, but what this gives us is really, when I'm looking at possibly purchasing it, my base KGAR is 15%. I'm giving myself a 2.5% margin of safety. So I really want to see like a realistic goal of me getting 17.5% KGAR average on this over the next 5 years. And we would be there in the very bullish case. Buy target would be 137. The bullish case would be 102, which we're barely there. The base case, and I usually want to accumulate in the base case to bearish case. Base case would be 76, bearish case would be 58, very bearish would be 44. So, I mean, that's a lot of downside risk. If it does get to that bearish scenario, we've got 40% downside risk. So, yeah, I don't know. For me, I would probably have to see. I'd either have to see them expanding bottom line way more rapidly than what they have been, or I'd have to see a pretty steep drop in the price of the equity. Or I would have to do more research, get a way better understanding of the company, and if I saw things that gave it a lot more potential, a lot more future, tailwinds, which that could be the case. Those things could be priced in, and I just don't know about them, right? So when you're just doing a very surface level qualitative analysis and then jumping into your quantitative analysis, your quantitative analysis can be a bit off if you're missing some of those big factors that would make you adjust your growth numbers or your margin or your bottom line growth numbers from like margin expansion or something like that. So I might just not know what the market knows. But as of now, I wouldn't really be interested in this unless it got probably below 75, 76, which we could see in the past. It seems to be supported pretty strong. If it gets down there, it usually gets bought up pretty quickly. So with these assumptions, the 5 years price target would be in the very bearish scenario, $100. The bearish scenario would be $130. The base case would be $172. The bullish case would be $228, and the very bullish would be $307. So that's what we got. Hope you enjoyed this. Give it a like and subscribe if you want. And yeah, we'll catch you in the next one.